In 1929, the Federal Reserve made a decision that would echo through history for 9 decades. They raised interest rates to fight speculation, tightening monetary policy even as the economy began to slow. The result was catastrophic. The stock market collapsed, banks failed by the thousands, and the world plunged into the Great Depression that would last more than a decade. 90 years later, in 2019, the pattern began to rhyme. The Federal Reserve, after raising interest rates 9 times in 3 years, suddenly reversed course. They cut rates 3 times in rapid succession, describing it as insurance against a potential downturn. Markets celebrated, the expansion continued, and then 2020 arrived with a pandemic and another market crash. Now, as we sit in 2025, another 90 years since that fateful decision in 1929, the Federal Reserve finds itself in a strikingly similar position. They've raised rates aggressively to fight inflation. They're now cutting rates while inflation remains elevated, and historical patterns suggest we may be approaching another major inflection point. This isn't prophecy, and this isn't coincidence. This is pattern recognition. The Federal Reserve follows cycles that repeat with mechanical precision, and understanding these cycles might be the difference between being prepared and being blindsided by what comes next. Let me walk you through the 3 moments, 90 years apart, in the case of 1929 and 2019, and show you exactly how the Federal Reserve's playbook repeats, why it matters, and what the patterns suggest for the years ahead. The year is 1928. America is in the middle of the Roaring Twenties. Stock prices have quadrupled since 1921. The Dow Jones Industrial Average stands at unprecedented heights. Everyone who can borrow money is borrowing it to buy stocks. Margin debt, the amount of money borrowed to purchase securities, has reached 10% of the entire economy's output. Taxi drivers are giving stock tips. Barbers are discussing the market between haircuts. The phrase permanently high plateau enters the economic vocabulary, describing the widespread belief that stock prices have reached a new sustainable level from which they will never significantly decline. But beneath this euphoria, members of the Federal Reserve Board are growing increasingly concerned. They don't see sustainable growth. They see dangerous speculation. They see ordinary Americans borrowing money they can't afford to lose, pouring it into stocks they don't understand, and they believe it's the Federal Reserve's responsibility to stop it before it gets worse. In their view, the central bank exists not just to manage the economy, but to prevent excesses in financial markets. So in 1928, the Federal Reserve begins raising interest rates. The discount rate, which is the interest rate at which banks can borrow from the Federal Reserve, increases from 4% to 5%, then to 6% by August 1929. This is a 50% increase in borrowing costs in less than 2 years. The stated goal is explicit and documented in Federal Reserve meeting minutes. They want to limit speculation in securities markets. They want to make it more expensive to borrow money for stock purchases. They want to cool down what they perceive as an overheated market. But there's a problem that the Federal Reserve either doesn't understand or chooses to ignore. Raising interest rates doesn't just affect speculation. It affects everything. When the cost of borrowing money increases, businesses postpone expansion plans. Construction projects get delayed because financing becomes too expensive. Automobile purchases decline because monthly payments become unaffordable. The entire economy begins to slow down, not just the stock market. And there's another problem. The world in 1928 operates under something called the gold standard, which links currencies and monetary policies across nations. When the United States Federal Reserve raises interest rates, it attracts gold from other countries as investors seek higher returns. This forces foreign central banks to also raise their rates to prevent gold from flowing out of their countries. The Federal Reserve's decision to tighten monetary policy to fight American speculation triggers recessions in nations around the globe. Germany, Brazil, Argentina, they all enter economic downturns in 1928 and 1929 because the Federal Reserve decided to fight a stock market bubble. By the summer of 1929, the American economy is already contracting. industrial production is falling, steel output is declining, automobile sales are dropping, construction has stagnated, but most Americans don't notice yet because the stock market is still climbing, still reaching new highs through September. The disconnect between the real economy and the financial markets has never been wider. Then October arrives. On October 24th, 1929, Black Thursday, the market falls 11% in a single day. Panic spreads through Wall Street. The next few days see a brief recovery as major bankers pledge to support the market, but it doesn't last. October 28th and 29th, Black Monday and Black Tuesday, bring devastating declines. The market loses over 20% of its value in 2 days. Investors who borrowed money to buy stocks receive margin calls. They're forced to sell. The selling triggers more margin calls, more forced selling. The cascade has begun. Now, here's where the Federal Reserve's 1928 decision reveals its full consequences. In the immediate aftermath of the crash, the New York Federal Reserve Bank, led by competent officials who understand the severity of what's happening, takes decisive action. They lower interest rates. They inject liquidity into the banking system. They do exactly what a central bank should do during a crisis. And it works. The panic is contained. Markets stabilize. By the end of November 1929, it looks like the worst might be over. The Federal Reserve has successfully prevented the crash from becoming a catastrophe. But then the Federal Reserve makes another decision that will define the next decade. Throughout 1930 and 1931, as banks begin failing and the economy continues contracting, the Federal Reserve refuses to expand the money supply. Some members believe the speculation of the 1920s was fundamentally unsound and the economy needs to purge these excesses before it can truly recover. Others worry that monetary expansion will just reignite another round of speculation. The Federal Reserve Board in Washington repeatedly blocks proposals from the New York Federal Reserve to buy government securities and inject money into the economy. The money supply contracts by over 30% between 1929 and 1933. Then, in September 1931, Britain is forced off the gold standard. Investors fear the United States might do the same. In response to this fear, the Federal Reserve raises interest rates again. They tighten monetary policy in the middle of a collapsing economy because they're more concerned about defending the gold standard than supporting economic activity. This decision, more than any other, transforms what might have been a severe recession into the Great Depression. From 1929 to 1933, the economy contracts by over 25%. Unemployment rises from 3% to 25%. 9,000 banks fail, wiping out the savings of millions of Americans. The Dow Jones loses 89% of its value. The Federal Reserve, by raising rates to fight speculation in 1928, then failing to respond adequately after the crash, then actually tightening policy again in 1931, creates the worst economic catastrophe in American history. This is documented fact. Federal Reserve meeting minutes, contemporary accounts, and decades of subsequent economic research all confirm it. The lesson seems clear. Central banks should not raise interest rates aggressively to fight asset bubbles. They should focus on economic stability, not market prices. And if a crash occurs despite their best efforts, they must respond immediately and massively with monetary expansion. These lessons are taught in every economics course. They're codified in central banking doctrine. Federal Reserve officials in the modern era repeatedly reference the mistakes of 1928 through 1931 as examples of what not to do. And yet, 90 years later, the pattern begins to repeat. The year is 2015. The United States is 6 years into an economic recovery following the 2008 financial crisis. The Federal Reserve has kept interest rates at zero since December 2008. They've printed over $3 trillion through quantitative easing. They've done everything possible to support the economy, and it's worked. Unemployment has fallen from 10% to 5%. The stock market has more than doubled. GDP growth is steady, if unspectacular. The expansion is entering its 7th year, becoming one of the longest in American history. And the Federal Reserve decides it's time to start raising interest rates. December 2015 marks the first rate increase. Just 25 basis points, 0.25%, but it's symbolic. The Federal Reserve is beginning to normalize monetary policy. They're moving away from emergency measures towards something more conventional. Over the next 3 years, the Federal Reserve raises interest rates 9 times. By December 2018, the federal funds rate stands at 2.5%, up from 0. Each increase is accompanied by statements about the strength of the economy, the healthy labour market, the need to prevent the economy from overheating. But something changes in late 2018. The stock market, which had been climbing steadily throughout the rate increases, suddenly drops. December 2018 sees the worst December for stocks since the Great Depression. The S&P 500 falls nearly 20% from its September peak. Corporate borrowing costs are rising rapidly. Companies that issue debt at low interest rates now face refinancing at much higher rates. The housing market, which had been recovering, starts to soften as mortgage rates climb above 5%. And global growth begins to slow, particularly in China and Europe. The Federal Reserve, entering 2019, had projected 2 more rate increases. They believed the economy could handle higher borrowing costs. But market participants and economic data start telling a different story. The yield curve, a reliable recession predictor that measures the difference between short-term and long-term interest rates, inverts in March 2019. This means short-term rates are higher than long-term rates, which historically signals that investors expect economic trouble ahead. In July 2019, the Federal Reserve makes a dramatic reversal. After 9 rate increases over 3 years, they cut interest rates by 25 basis points. It's the first rate cut since the Great Recession. Federal Reserve Chairman Jerome Powell describes it as a mid-cycle adjustment, insurance against potential downside risks to the economy. He explicitly states this is not the beginning of a long cutting cycle like the ones that occurred during recessions. It's a recalibration, a response to trade tensions with China, slowing global growth and inflation that's running below the Federal Reserve's 2% target. The decision is controversial. Some Federal Reserve officials vote against it, believing rates should remain unchanged. President Trump is furious, demanding much more aggressive rate cuts. The economy is growing at over 2%. Unemployment is 3.7%, near a 50-year low. To many observers, cutting rates with such a strong economy seems premature. But Powell and the majority of the Federal Reserve believe they're being prudent, taking out insurance against risks they see building in the system. September 2019 brings another 25 basis point cut. October 2019 brings a third cut. In less than 4 months, the Federal Reserve has reduced interest rates by 75 basis points from 2.5% to 1.75%, and then they stop. Powell signals in late October that the rate cuts are complete unless economic conditions deteriorate significantly. Markets stabilize. The expansion continues into 2020. Everything seems fine. The Federal Reserve has successfully engineered a soft landing, adjusting policy to extend the expansion without triggering a recession. Then March 2020 arrives. A virus that started in China spreads globally. Economies shut down. Markets collapse. In less than a month, the S&P 500 falls 35%. The Federal Reserve, which had just cut rates 75 basis points as insurance, suddenly needs to deploy everything. They slash rates back to 0. They launch a new round of quantitative easing, printing trillions of dollars. They establish emergency lending programs. The insurance they purchased with those 2019 rate cuts proves wholly inadequate for the actual crisis that arrives. Now, here's where the parallel to 1929 becomes illuminating. In both cases, the Federal Reserve raised interest rates aggressively before the crisis. 1928 through 1929 saw rates go from 4% to 6%. 2015 through 2018 saw rates go from 0 to 2.5%. In both cases, the tightening was motivated partly by concerns about speculation and asset prices. In 1928, it was stock market speculation. In 2018, it was concerns about financial stability and preventing bubbles from forming. In both cases, the economy began showing signs of stress before the crash. 1929 saw industrial production declining in the summer before the October crash. 2019 saw manufacturing data weakening, yield curves inverting, and global growth slowing. And in both cases, the Federal Reserve attempted to ease policy before the crisis, but the easing proved insufficient. 1929 saw rate cuts in November after the crash. 2019 saw rate cuts before the crash, but then a much larger crisis arrived anyway. The difference is in what happened after. In 1931, the Federal Reserve actually tightened policy again, raising rates in defense of the gold standard. This was the catastrophic error that turned a recession into a depression. In 2020, the Federal Reserve did the opposite. They slashed rates to zero immediately. They printed money on an unprecedented scale. They did everything the Federal Reserve failed to do in the 1930s, and it worked, at least in preventing a depression. But here's what's crucial to understand. The pattern isn't about whether the Federal Reserve responds correctly after a crisis. The pattern is about the setup. Both times, the Federal Reserve spent years raising interest rates. Both times, they created stress in the financial system through tightening monetary policy. Both times, they then attempted to ease policy, but the easing came too late or proved insufficient. And both times, approximately 90 years apart, a major market crash and economic crisis followed. Which brings us to now, 2025, and the question that should concern anyone paying attention. Is the pattern repeating again? Let's look at what the Federal Reserve has done since 2020. After slashing rates to zero and printing over $4 trillion in 2020 and 2021, the Federal Reserve faced a new problem in 2022. Inflation, which had been dormant for decades, suddenly surged. The combination of massive monetary stimulus, supply chain disruptions, and fiscal spending pushed inflation above 8% by mid-2022, the highest level in 4 decades. The Federal Reserve's response was the most aggressive rate hiking campaign in modern history. Beginning in March 2022, they raised interest rates from 0 to 5.5% in just 18 months. This is faster than any tightening cycle since the 1980s. Each meeting brought either a quarter point, half point, or, in some cases, 3/4 point rate increase. The message was unambiguous. The Federal Reserve would do whatever it takes to bring inflation back down to their 2% target, even if it meant causing a recession. The tightening had immediate effects. The housing market, which had been booming during the pandemic, froze. Mortgage rates doubled from 3% to over 7%. Home sales plummeted. New construction slowed. The tech sector, which had thrived with low interest rates and easy borrowing, collapsed. Companies that were unprofitable but growing rapidly suddenly faced a world where investors demanded profits, not just growth. Stock prices for these companies fell 70, 80, 90%. The cryptocurrency market, which had exploded during the pandemic, lost over $2 trillion in value. Corporate borrowing costs surged. Companies that had issued billions in debt at 2 or 3% interest rates now faced refinancing at 7 or 8%. This was manageable for profitable, stable companies, but devastating for over-leveraged firms. Regional banks, which held significant amounts of commercial real estate loans and long-term bonds, suffered massive losses as interest rates rose and bond prices fell. In March 2023, Silicon Valley Bank collapsed, the second largest bank failure in American history. 2 more banks failed in the following weeks, but inflation started falling. By late 2023, it had dropped from above 8% to around 3%. Not the Federal Reserve's target of 2%, but moving in the right direction. The labour market remained strong. Unemployment stayed below 4%. The economy continued growing, defying predictions of an imminent recession. The Federal Reserve seeing this progress, signalled in late 2023 that they might be done raising rates. The tightening cycle appeared to be ending. Then came 2024. The Federal Reserve held rates steady through most of the year, waiting to see if inflation would continue falling without further rate increases. By mid-2024, with inflation stubborn but not accelerating, and with some signs of labour market softening, the Federal Reserve began preparing markets for rate cuts. In September 2024, they cut rates by 50 basis points. November and December brought two more quarter-point cuts. The federal funds rate fell from 5.5% to 4.5%. The cutting cycle had begun. 2025 has continued this pattern. The Federal Reserve cut rates in September and October, bringing the target range down to 3.75 to 4%. But here's where it gets complicated. Inflation, which was supposed to continue falling, has stopped declining. It's stuck around 3%, well above the Federal Reserve's 2% target. Core inflation, which excludes food and energy prices and is often viewed as a better measure of underlying inflation pressures, is at 2.9%. Consumer spending has weakened. Job growth has slowed significantly, with revisions showing much weaker hiring than initially reported, and the Federal Reserve finds itself in the exact same position they were in during 1929 and 2019. Caught between conflicting signals, attempting to thread the needle between preventing a recession and allowing inflation to resurge. Federal Reserve officials are openly divided on what to do next. Some want to continue cutting rates to support the labour market. Others want to pause or even stop cutting because inflation remains elevated. The meeting minutes show sharp disagreements about the appropriate path forward, and markets are uncertain. Some days, investors bet on more rate cuts. Other days, they price in no further easing. The Federal Reserve has lost the clear communication and forward guidance that characterized much of the past decade. Now, let's connect the three periods and see the A pattern. In 1928 through 1929, the Federal Reserve raised rates aggressively to fight speculation, then attempted to ease after the crash, but the easing was insufficient and followed by catastrophic policy errors. In 2015 through 2018, the Federal Reserve raised rates steadily to normalize policy, then cut rates in 2019 as insurance against risks, but a major crisis arrived in 2020 anyway. And now, in 2022 through 2023, the Federal Reserve raised rates more aggressively than ever to fight inflation, and they're now cutting rates in 2024 and 2025, while inflation remains elevated and economic signals are mixed. The setup is strikingly similar. An aggressive tightening cycle, stress building in the financial system, an attempt to ease policy, an uncertainty about whether the easing is adequate or premature. The 90-year cycle from 1929 to 2019 marked major inflection points, peak speculation in 1929, the need for insurance cuts in 2019. And now, in 2025, historical patterns suggest we may be approaching another major turning point. But here's what's different this time, and this is critical to understand. The Federal Reserve has far less ammunition than they did in 1929 or even in 2019. In 1929, before they started tightening, interest rates were at 4%. They had room to cut. In 2019, when they started cutting, rates were at 2.5% and they could drop them all the way to zero if needed. In 2025, rates are at 3.75 to 4% and inflation is still almost 50% above target. If a crisis hits, how much can the Federal Reserve cut rates before hitting zero? Maybe 200 basis points, maybe less if inflation concerns prevent them from cutting aggressively. And if they hit zero, what then? More quantitative easing? They already printed over $8 trillion in the past 15 years. The Federal Reserve's balance sheet, which was under $1 trillion before 2008, now stands at over $6 trillion even after they've been reducing it. There's a real question about whether quantitative easing even works anymore or whether it just inflates asset prices without supporting the real economy. The government also has less fiscal space to respond. In 1929, federal debt was about 16% of GDP. Even after the New Deal spending of the 1930s, it only reached 40%. In 2008, federal debt was 65% of GDP. The government could and did borrow trillions for stimulus. In 2025, federal debt is 123% of GDP. The government is already running trillion-dollar deficits. If a crisis forces massive stimulus spending, debt could reach 150 or 180% of GDP. At those levels, debt service, just paying interest on the debt, consumes an enormous portion of tax revenue. So the Federal Reserve in 2025 finds itself in a uniquely vulnerable position. They've already raised rates and are now cutting, creating stress, then attempting relief. The pattern that preceded the 1929 and 2020 crashes, but they have far less capacity to respond if something goes wrong. Less room to cut rates, less credibility for quantitative easing, less fiscal space for government stimulus. The policy tools that worked in 2020 might not be available or effective in 2026 or 2027. Here's what the historical pattern suggests, and I want to be very clear about this. This is not a prediction that a crash is guaranteed. This is pattern recognition showing that the Federal Reserve's policy cycles create conditions that make major financial disruptions more likely. When the Federal Reserve tightens aggressively, it creates stress in the financial system. When they then attempt to ease, it's often a signal that they recognize something is wrong. And historically, this tightening followed by easing has preceded major market events. 1928, tightening led to 1929 crash. 2015 through 2018, tightening led to 2019 insurance cuts and 2020 crash. 2022 through 2023, tightening has led to 2024 through 2025 cuts. The timing isn't precise. Sometimes the crisis comes immediately, sometimes it takes a year or two. But the sequence is consistent. Aggressive tightening creates vulnerabilities. Subsequent easing acknowledges those vulnerabilities. And then some trigger, whether it's a pandemic, a banking crisis, a geopolitical shock, or simply the weight of accumulated debt, causes the system to break. What might trigger the next crisis? There are several candidates visible right now. Commercial real estate is deeply troubled. Office buildings sit 40 to 50% empty due to permanent work from home shifts. These buildings were financed with mortgages at 3% that are now refinancing at 7 or 8%. The math doesn't work. Defaults are rising. Regional banks, which hold most of these loans, are under stress. This could cascade into a banking crisis larger than March 2023. Corporate debt is at record levels relative to GDP, over 70% compared to 43% before the last crisis. Much of this debt was issued at low interest rates and is now maturing, requiring refinancing at much higher rates. Some companies won't be able to afford it. Major defaults could trigger contagion, causing credit markets to freeze. Geopolitical risks remain elevated. Conflict in the Middle East could disrupt oil supplies, causing energy price spikes that reignite inflation. Tensions with China over Taiwan could spark a crisis that makes COVID look manageable. Any major shock to the global system could be the trigger that exposes the vulnerabilities created by years of aggressive monetary tightening. Or it could be something we're not even watching yet. In 1929, nobody predicted a pandemic would shut down the global economy 90 years later. The trigger is often something unexpected. What matters is that the Federal Reserve's policy creates conditions where a trigger, any trigger, can cause outsized damage. So what should you understand from this 90-year pattern? First, the Federal Reserve follows predictable cycles. They tighten too much, they ease when they recognize they've tightened too much, and then something breaks. This happened in 1929, it happened in 2020, and historical patterns suggest it could happen again. Second, the Federal Reserve's capacity to respond is more limited now than ever. Less room to cut rates, less credibility for money printing, less fiscal space for stimulus. The tools that worked before may not work next time. Third, Timing is uncertain, but conditions are set. The next year or two could see a major financial event. It might be smaller than 1929 or 2020, or it could be larger given the accumulated debt and reduced policy space. We don't know what will trigger it, but the Federal Reserve has created the conditions where a trigger could cause significant damage, and finally, preparation matters more than prediction. You don't need to know exactly when or how a crisis will unfold. You need to understand that the pattern exists, that conditions are being set, and that positioning yourself accordingly could be the difference between weathering the storm and getting swept away by it. The smart money in 1929 saw it coming and got out. The smart money in 2019 positioned for volatility and profited. The question is whether you'll recognize the pattern in 2025 and act accordingly. The Federal Reserve's 90-year pattern isn't mystical. It's not about sacred numbers or cosmic cycles. It's about human psychology and institutional behavior. Central banks make the same mistakes because they face the same pressures. They tighten too aggressively trying to prevent problems. They ease when they realize they've gone too far, and they often lack the tools or willpower to prevent the crisis that follows. 1929 taught us this lesson. 2019 reminded us, and 2025 is setting up the same conditions once again. If this showed you a pattern you hadn't seen before, if you understand now that the Federal Reserve's policy cycles follow recognizable sequences with predictable vulnerabilities, then you're seeing what most people miss. The pattern isn't destiny, but it's powerful, and those who recognize it have a chance to position themselves before the next major turn, while everyone else is still celebrating the expansion that's about to end. History doesn't repeat exactly, but it rhymes. The question is whether you're listening to the rhythm before everyone else starts running for the exits. If you want to understand how these cycles work, how to read the signals the Federal Reserve is sending, and how to position yourself before the crowd figures it out, make sure you're subscribed because we're going to continue tracking this pattern as it unfolds in real time. Hit that like button if this changed how you see Federal Reserve policy, and drop a comment about whether you think the pattern will repeat again. The smart money is already positioning. The question is whether you'll recognize what they're seeing before it's too late.